Welcome back to Rockstock Channel. It is Tuesday, December 19th at 5:45 a.m. And this is the last Rockstock Channel interview of the year. I am wearing my celebratory festive hat and also wearing a Michigan shirt because Michigan is #1 in the country and is playing Alabama in the Rose Bowl on New Year's. So go blue. We have, for the first time, two new guests, but people who I've known for a long time. We have Mac Whale, senior analyst at Cormark Securities and sell-side analyst in Toronto, and Darko Kuzmanovic at Henderson Investors in Australia on the buy side. I've known both of these gentlemen for more than 10 years. In Darko's case, probably 20 years. So long experience with commodity cycles broadly, going back to the 2000 super cycle, but also having experienced at least three lithium cycles in the past few years. Mac, why don't you just introduce yourself a little bit more and what companies you currently cover on the sell side in the lithium space, and then Darko, if you could introduce as well and actually talk about some of your holdings in the lithium space, because you have a global mandate. You don't just invest in ASX listed stocks. Mac, why don't you start?
Sure. Yeah. Thanks for having me on, Howard. I've been at Cormark 19 years, or just almost finishing 19 years. I was at National Bank prior, and back in the 90s, I did a lot of work and I did a PhD at MIT, and then was a professor out west on the West Coast, and did a lot of work in fuel cells and hydrogen production and solar cells and that type of thing. So my background is really thermodynamics, heat transfer, National Bank and Cormark, basically to cover originally technology stocks, and then it branched out into power and renewable natural gas and all the battery metals. And so I think my approach is really a processing approach. We have lots of geos, professional geologists at Cormark that will look at the actual resources and do that kind of work. But in this space, and we could perhaps get into that a little bit, so much of the value add is in the processing. It's really important to understand that. So I find that tack that I take has been helpful over these cycles. So I'm sure we'll get into that on this call today.
And you cover, Mac, which stocks?
Yeah, I cover Lithium Americas for a long time now. Lithium Argentina, Frontier, Critical Elements, Lithium Ionic, Sigma Lithium, Lithium Royalty Corp. So obviously a big TSX Venture focus, but we also cover, we have looked at and are doing reports on regional reports. So we have all the guys in Nevada, some of which are ASX listed, and same thing in Brazil as well, and taking a look at African names as well, increasingly. So there's a few companies that we don't actually have targets on yet, but officially cover them.
And you cover Patriot as well.
And Patriot, yeah.
Okay.
And remember.
All right, Darko.
I've been in the investment industry since 1994. My original background is a metallurgical engineer. I've worked in various operations around Australia, lead and zinc, gold, and then also an engineering firm that designed and constructed process plants.
Okay, and Darko, in your funds, what stocks in lithium do you currently own?
Right now, we're kind of playing a strategy which is more of a development story rather than necessarily earnings-driven companies, because obviously they're in earnings downgrade mode. So we used to have Albemarle, SQM, Allkem, etc. And given the negativity at the moment, we've shifted some of our exposure to things like Patriot. We are in Pilbara because I think that's a cheap name for what it's doing and where it's going. We've been in Azure, a company called Wildcat, and then obviously looking for the next series of names to get involved with.
Okay, great. We'll get into those specific names later. I think I'm very interested in getting both of your perspectives because the RK Equity Scoreboard has a vast kind of divergence of valuations of companies at various stages of development. We've talked about, the Pierre Lassonde curve on from exploration to production, and then that middle period. But when price declines as much as it has, then exploration, may do less well. Before we start today's video, we'd like to thank Lithium Royalty Corp, listed on the Toronto Stock Exchange, ticker symbol LIRC. We'll share more later in the video. So there's been a lot of volatility in the market. So I want to speak to that first. And we had Ken Brinsden on the podcast recently, a very well liked, and but we made a lot of comparisons to iron ore in that. And I want to call up a couple of charts here that compare like the lithium price to the iron ore price. There's lithium carbonate. We often compare spodumene to iron ore, and the parallels are not exact, of course, but it's very much Australia-driven spodumene going into China and also Brazil in a similar way that spodumene is there. So what one thing Rodney and I we've been lamenting or complaining or unhappy that the price has fallen so far, and we had called the bottom in April, and then we've had a lower low, but the fact that it's happened so fast is actually a good thing. So just by comparison, the last cycle, we call up this chart here, the last cycle was from like December 27th, the peak is at 171,000 renminbi, and then in November 2020 we had a trough of 39,000 RMB, which was a 77% decline over 3 years. And then in the ensuing 2 years we went from that 39,000 all the way to 597,500, which was a 1,400% gain in 2 years. But then from that peak, which is literally just 13 months ago, we have fallen now to 98,500, which is an 83% decline in 1 year. So that 83% decline is more than the 77% decline that we had, over a 3-year period from 2017 to 2018 to 2020. So might we have a quite sharp reversal, given how fast we have fallen? And I think there are parallels, in iron ore. If we call iron ore chart, there's a long-term iron ore chart, and actually people compare. So, lithium's immaturity is the reason for its volatility, but a relatively mature industry like oil is very volatile, and a relatively mature industry like iron ore is also very volatile if you look at this chart. So we can go back like a long way, and you can see the rise in the super cycle, and we could talk about that. But in the more recent term, we have seen iron ore from April 2020, which was bottom of COVID, or the very beginning of COVID. Iron ore went to $84. And 18 months later, June 2021, it was at $215, right? 153% rise. But then 5 months later, it was down to $90, 58% decline. I remember being on a mineral resources call, and they went from paying very high dividends to paying no dividends, and it was like a big shock. But that's actually when mineral resources, mineral resources used to trade with the iron ore price. It was that period of time where it shifted to start trading with the lithium price. And now it's going back to a little bit iron ore. I think it's been a bit, supported there. But in any event, we had this 58% decline in 5 months. And then 4 months later, it was at $147, March 2022, a 63% rise. Then 6 months after that, it had fallen 36% to $94. And then now it's back up to 131, just 6 months later. So you've had very significant 6-month volatility within iron ore. Maybe Darko, you cover iron ore and these markets. What's happening China-wise in the iron ore market? Are there parallels to that recent up and down that you could draw to what's been happening in lithium?
The first observation is, one, iron ore is not rare. It's everywhere. It's just not everywhere in the concentrations and quality that's needed to make a viable long-term iron ore operation. First of all, the industry is highly consolidated. It's an oligopoly, really. You look at the top three Australian producers, Rio Tinto, FMG, and BHP. MinRes is very small in that situation. And then you've got Vale. They dominate the global seaborne iron ore trade. So volume growth is managed and controlled. They do respond to market demand, but demand isn't growing materially. In fact, I think what surprised the market is that demand hasn't fallen as kind of expected or anticipated by the market, especially with the slow in China. And what's happened is Chinese steel production actually hasn't declined, which if you look at the commodity boom, China came from nothing back in the 80s, 90s to be a billion ton steel industry, which is compared to the US, which is about 80 to 100 million ton. That's a significant difference. And that all happened in a period of probably 20 years, which was the commodity boom that China drove. It doesn't grow at that rate anymore. It's flat. And the market's been anticipating that global Chinese steel capacity will fall because their industrialization and urbanization phase it hasn't stopped, but the rate of change has really stopped. It's low growth now. But what they've managed to achieve, especially in the short term, that's why the price has spiked, is that they are exporting more steel than anyone's anticipated. So whilst their domestic economy isn't consuming as much, that they're managing to export it to other people, therefore steel production is pretty high. Driven by also relatively, I wouldn't say low, but not very high inventory. And the buying patterns of Chinese steel mills are really driven by margin. So if their steel price increases, they're quite happy to buy and pay more for iron ore because they're extracting a reasonable EBITDA margin on their product. Now, if they were to stop that, go from a profit to a loss, they'll stop producing steel. So they're very adaptable. And when you've got a supply-driven market it's dominated by key suppliers who overwhelm the consumers, you get a very orderly market, which is what the iron ore market is. Very different to anything. So you talk about OPEC and you talk about oil and gas. Let's say oil. Even OPEC today is struggling to control the oil supply because there's so many different suppliers. You've got a major development in Guyana with Exxon. That's going to grow to over 1 million barrels a day at some point. So you've got a lot of sources of supply, lots of competition, whereas that's not the case in iron ore. So if we translate that to lithium clearly is not there yet. Okay, it's an emerging industry, as we'd say. Clearly, 5 years ago, there was probably really only 3 to 5 key players. Chinese Ganfeng Jiangxi, Albemarle SQM, and now Livent Allkem. Since then, you've got a number of kind of new players coming in. Pilbar's come in. You'll have Lithium Argentina coming and ramping up. They could be a substantial player. You've got MinRes, of course. So whilst the industry is growing, new entrants are also coming. And the industry is yet to get to that phase where there's an equilibrium. I don't expect there will be one for a while because it's a fast growth industry. But we are starting to see some elements of consolidation, which might help, if you like, supply and demand dynamics, which might then help price volatility. As far as price, who would have expected from the bottom of the last downswing to now that product prices or chemical prices would be $80,000 a tonne? No one. I remember as we were entering that downswing, the marginal cost of production that was forecast by brokers was $7,500 a tonne. Okay, and that was kind of it. And now here we were at 80, and we're back to 20, and 20 is still good. Okay, it's just that move up to 80, I think what's changed this time to the last downswing is that the players that came into this market are very different players to who were there before. I think the move to 80 has just attracted so much more capital from so many sources. And then clearly, it's attracted hedge funds. So people that can short the space. And if you look at a Pilbra's got something like 17% short position in the stock. Liontown was something like 12 to 14% short just before the Albemarle bid. So that's what's happening in the space. That'll all change over time, but that's where we are today.
Okay, great. So let me just pick up on that. I tweeted about short positions in American listed stocks last week, LAC, Piedmont, Albemarle, and Livent. We had what seemed to be a bit of a short covering rally, last week on the back of the Fed, forecasting, rate cuts and the end of the rate rise cycle. And there was some speculation on COP 28, commentary there, but I think it was more that. So Mac, what do you, what do you think price wise and what's happening in the market?
Yeah, there's a lot to unpack in that. And as I was listening, a bunch of things hit me. So maybe I'll go back a little bit. When we started covering back in Taliesin days, actually, in 07, we have this really good chart that sort of shows pricing over 20 years. And it's interesting because we don't really look at much of the spikes. If I showed you, you could see this line that does this. And every time there's whatever noise and it comes down and hits that line and it goes below pretty shallow, comes right back up. And then it does that again and again and again. So in our it's done it 4 times actually, but the declines are very shallow. So in this particular round, the last one, we keep each time, if I go back and look at my notes, I charted out my sort of incremental, like the way that line goes is what we use in our long-term pricing. And sure enough, it's 8 and we moved it up to 12, then 15, 17 and a half, 20. Like you can see it and it hits, it goes below, and it can go below in the time frame. When you show that chart, it looks horrible, right? When you're living it. And it can go lower from here, and it can go well into the low teens, but it'll snap back. And when you look at that on that long-term chart, it's a tiny, shallow decline below that line. And then it usually it's off to the races again. So earlier when you were talking, part of what's happening, unlike iron, is, and you mentioned it, Darko, the fact is you're building a brand new industry. So it's not new entrants taking market share in a world that's growing at GDP, which goes through then a recession, then GDP goes back, right? You certainly do have that. Plus you have a whole secular industry being built upon that cycle. So you're going to see sometimes a compounding effect when both of those are coinciding to the upside or the downside, or they're mixed. And I think what we've been seeing is exactly that play out over this year. So it makes complete sense, given Chinese buying habits, that you would see this reaction. The price would go down, particularly in a world in which everyone's worried about GDP and recession and global recession. So that was the foregone conclusion. And now we're living out that bottom part, where I'm expecting it'll go down, stay low, get that washout trade, and then we'll be back in a sort of a growth mode, coinciding with sort of economic growth along with Chinese buying, and that's what you get, another jump up. But in the end, it'll come crashing down again, and probably, if that plays itself out over a 2-year period, then we could be having this call again in 2 years or 3 years, and it'll be the same sort of pattern because of this extremely tight situation with demand rising smoothly and supply going in chunks, where you oversupply and then the demand catches up, etc. So expect that to happen for the next decade. That's the way I look at it, and you have to live through those cycles. So when it comes to the stocks, like I was having some drinks last night with some fund managers that are more generalist, and we were talking in our morning meeting. I asked them about this because we were bringing it up in the morning meeting, how powerful the general rally has been in Western stock markets over the last, call it, month. And I'm looking at him going, my screen has been red for that whole time. Can you put it in the context? Like, it's terrible. And he goes, the crap you're looking at is terrible, Mac. What do you mean? And he goes, and then we went through it all. And he said, yeah, this is one of the most powerful rallies Had it not been for the last 5 weeks, most fund managers in Toronto would be sitting there going, we're in another down year, and 22 was terrible. Because of this rally being general in nature, it hasn't yet gone to the stocks that are, what do you call it, the more resource stocks here in Toronto. And that may take months before that catches up. So we're looking at the situation where you're seeing a general improvement, and it has to do, as you rightly pointed out, Howard, with the interest rate changes and just the perception that we're through the worst part of that. But it hasn't got anyone looking at resource stocks yet. And so that continues to be like, it's a struggle even to show people, the price chart, and you show them and you say, look, Lithium Royalty Corp will absolutely rip when this returns, right? It's got none of the financing risk directly, and it has all the exposure to a diversified set of companies developing, and it has all the price exposure, and it's not even moving. In fact, it's going down a little bit lower. So it's a tough situation to advise people to get ahead of that. But it will turn, and it takes that turn before the rest of the investors pile in. But pretty confident we're seeing the lows, even though it could be lower for a month. It could be lower for a couple months, but I think we're in that phase where we're washing out.
So Darko, one of the things we see in amongst the pricing cycle that's been volatile is thematics that become popular and then they don't. And we've seen various plays like unconventional flow sheets and then back to conventional hard rock and brown. It's mostly been hard rock, but within that, we then see themes. We had a period where, and we agree, we think North America has opportunity where TSX and Canadian lithium plays took off. Quite a lot of actually invested on the ASX, and then we've now had this raft of M&A going on in Australia. It seems if you don't have a Wallabies cap on, you get a black eye if you step into the space there. So there's more news coming out. So your thoughts on the shift, how that might play out, where the M&A is going on the ASX with Chris and Gina, and then is your thoughts on valuations for non-Aussie plays that have come off quite a bit recently.
First, just a general observation about the TSX versus the ASX. I remember when I first started in the space, the place you wanted to be is the TSX, because that was dynamic, exciting. Companies are raising money, the investors were there, supporting juniors, mid caps, etc. I think that's actually dissipated over the last probably 3 to 5 years. Where actually I think the ASX is a much more dynamic market for juniors than the TSX. Now, there's probably a number of reasons. I think partly because I think the odd thing about Canada is that if you look at the China-driven resource boom, whilst Canada participated, it never was really focused on China. So it was really more focused on the US because it's got a manufacturing industry, it's integrated into all sorts of industrial activities. And yes, it's got nickel, and yes, it's got copper, but it never really got into that China thematic, whereas Australia has. And probably the best example is hard rock, lithium. 5 years ago, the leading producer of lithium was, the brines from Chile, Marlin SQM. Within 3 years of that, Australia is the leading producer of lithium, all from hard rock. It's just significantly transformed, the landscape over the last 2 or 3 years. Now, why did it do that? It becomes access to capital and the dynamism of companies who are looking at opportunities and aggressively moving. And I guess over the last 12 to 18 months, not only the companies themselves have made money, but investors have made money, which is more important. As investors have made money, they're now happily recycling into smaller and smaller names doing the same thing or trying to do the same thing. Whereas if you look at Canada, its history in lithium is a bit mixed, in fact, negative. I'd probably say if you look at the, you've got Canada Lithium, Canada Lithium, that was a disaster. Nemaska was a disaster. Those are not great examples of projects and stories that would draw in investors from Canada, especially in a market when juniors are not that interesting or not well supported. So there's a total difference in the market. And what I've noticed in Australia is that everything can be financed very quickly and very simply, and it has been. And more so, I think the other aspect of the dynamism is that the Australians have been very aggressive to move off into Canada. So I would imagine, I can't give you the whole number, but there's more Australian companies exploring for lithium than Canadian companies exploring for hard rock in Quebec and Ontario, which sort of says something. And at the same time, the new emerging Brazilian space is also lots of Australians going back into that, although there are obviously other companies there. So I think the Australians have been a lot more dynamic, a lot more flexible, and have had access to capital. In terms of valuations, I actually find the whole thing perplexing. If you look at the last downturn back in 2018, if I just use Albemarle as an example, Albemarle as a corporate was trading at 15, 16 times EV/EBITDA. That's the sort of metric we use. Today, it's trading on 6, okay, on 23 numbers and 9 on 24 numbers, and that's assuming there's got earnings downgrades, which is what we're seeing, earnings downgrades in the space. So the irony is, despite a strong underlying demand in the products that they produce, the very strong structural setting that will last for quite a period of time, most of these companies have been derated by investors, which I find fascinating. And I haven't got an answer for that. I mean, if I take a more extreme view, Ganfeng, I remember looking at its EV/EBITDA, it was like 35 times back in 2017, 18. And today, just bring it up, it's ridiculous, to be honest. It's 10 times. So I don't have an answer for that, other than maybe it's just, broad investors coming in, obviously selling the space down because it's been a great short opportunity. But the question, I guess, is will these stocks re-rate over time as the sector, as the space realigns itself and gets back to stronger prices, strong volumes?
I can jump on that issue if you don't mind.
Go ahead.
There is some things people need to be aware of. If you go back about 10, 15 years ago, Toronto, the regulations mandated that resource managers had to hold a certain percentage of their portfolio in Canadian stocks. They got rid of that. Australia didn't get rid of that. So you have, that is a supply and demand issue, right? So when you have a captive market with a certain amount of money chasing a certain number of deals, you get an inflated multiple. So that has to be kept in mind. So what's happened is, it's not that the market's not dynamic, that we have a lot of mining companies. In fact, one of the biggest exports probably that Canada has is brain power, with people finding other opportunities, whether it's in the tech space, entertainment, mining, they're all over the world, because there's not that many opportunities in Canada itself. It's a small economy. But the stock market has this structural regulatory artifact, in fact. And so that changed. There's talk that they may be bringing that back, but that's why. And so basically all our fund managers are globally looking. If you look at their percentage of what they own all over the world. And as you rightly said, Darko, a lot of US stocks. And they would look at valuations in Australia and go, I'm not touching any of that. It's way too highly valued. So they're out looking globally for value, and they're not finding it in Australia, which is this ironic sort of situation. When we come to the multiple, and then you have compounded on that, exactly as you said, Darko, this demand for materials in Australia, and you're in Australia, or from China, and you're in Australia supplying that, and you have a captive market. You can see you have all the effects for a bit of like a balloon, right? So that gets inflated, but it also, the opposite happens, and we're in that situation where nobody wants them. and nobody else is there but that money, you will see valuations go to the downside and it'll overshoot negatively. The other problem is when you look at the earnings market. If you look at all the quant and tech analysts, they look at earnings. And so they don't even look at EBITDA and they don't even look at cash flow. And as a result that's a much harder metric to do well at. So it's a tech focused and services focused market, and they do not understand resources. It's hard for them to get their head around it. So that just means there's fewer people looking, and it means your valuations are just lower because it becomes a niche. Whereas on the TSX or ASX, it's the other way around. There's the tech stocks aren't all that great. All the best people and best ideas are in the US and listed there. So meanwhile, you get all the better kind of mining stories are in other markets, right? So it's this interesting kind of dynamic that investors need to keep in mind, that it's a market and it's psychology and it's a supply and demand of an idea that you're paying for. And the multiple is completely arbitrary. And so that's why you'll even see, two companies trading on the same stock exchange in different businesses with different multiples. You look at all the metrics are the same: the ROE, the return on invested capital, like all sorts of metrics. One has a different multiple, and you go, why? What? It doesn't make any sense. You can get the same. You should be able to get the same return, the same value added economically, but you have a different set of investors, and they go, we're just not paying that for that company. We're going to pay this. And so the psychology is super important to understand in the cycle. But anyway, that's just my thoughts.
I think that those are great points. When I studied, at Columbia Business School, efficient markets, globalization, you would think that, information is available to everybody. Valuations across all the markets, should be the same. But
and the ASX, the ASX and the TSX are good examples of that. They are not efficient markets.
Exactly. But also in America. So there were times when Lithium Americas and Piedmont had crazy high valuations because the EV thematic was so strong, and they raised a lot of money at high valuations. But now, sentiment in the EV space is not great. Therefore, those stocks, which are dominated by U.S. trading, are trading relative.
And so, what do you have in the U.S.? This is interesting, right? With the narrative this fall got hit by a bunch of things. You had a big energy company saying, "Hey, look, or not energy, automakers, we can't sell these things. We can't sell vehicles. We can't sell full electric. So we're slowing everything down. We have high inventories." And everyone goes, "Oh, you can't sell them. Everyone's demand model's wrong." Then you had, look at Exxon, Chevron, Schlumberger, Koch brothers. They're all getting into DLE. The supply's going to, the demand is way lower forever. Supply is going to be way higher. And then you go, guys, stop trying to tell you, this is the psychology. I'm an investor. I lost a bunch of money. I need a story to tell myself to not jump off the ledge, right? And so it's not my fault. It's Koch brothers. It's and then they look and they say, it's OEMs. And all of those are stories people tell themselves because it's all red herrings. And if you work your way through it, you realize, oh, what are they going to do? They're going to sell more hybrids. Then you look at your demand model and you realize, and we've long had this hybrid dominant demand model. And when you tweak around with it, sure enough, you can make a battery. If someone can give you a battery, an OEM is going to throw that in a car, and they're going to get mandated to put that in a car, and they'll make money on it. So if you can make a battery and you can get lithium and put it in a battery, you're going to sell the battery. What do you care if it's in a hybrid or a battery electric? You don't in the end. You just care about your lithium being sold, right? So that when you look at your demand model, it's not that important, the mix. If you understand the behavior of the OEM, which is chase subsidy. Then when you go to the supply side and you dig into DLE and you go, DLE is not magic. Like you got those DLE circuits at the end of every single hydroxide conversion facility. You pick that up and you move it to the front and you put raw brine in, it's not going to work. And I wouldn't bet against big oil to figure out what you need to do in front of that, because they will need something in front of it to make what they have at the back of every circuit to work on the front. They will need to do something to that and change the adsorbents and maybe put multiple units of different types of adsorbent. Whatever they do will not be done by 2026 or 2028. It'll be 2030 plus. So your supply curve, and I would be hard pressed for any investor to look out 4 years. And when you show your supply demand going to 2030, you see the eyes glaze over. And I think the issue is those two elements to supply and demand will not have a factor in any time horizon that investors on the buy side should care about. And yet it informs how they're going to decide to invest this quarter or next year. So that's, you have to live through this sort of cognitive sort of dissonance where you have to understand that information, rationally absorb it, and then figure out what other people will do, and then position yourself in advance. And it's not necessarily the truth. It's more, what do you think will be the next story? So it's hard for someone with a scientific background to wrap my head around that, but that's how people are actually behaving. It's not all rational. So you start with a sort of rational viewpoint and then try to understand how it will play out. So we debate that literally every day at work, is that kind of dynamic. Like, what are people going to do now with this new information? So it's fascinating.
Mac, we may have to have you on again, like in January, because there is a lot, to cover here. But permitted mines are hard to find in this space. So it's good to be on the exploration side, and Azure could get bought, pre-resource. I think people don't worry too much about permitting in Western Australia, but outside of that, they do. And in America, in Canada, they do. So you have Critical Elements here is a permitted plain vanilla spodumene mine sitting at basically a U.S. market cap of $138 million. Yeah. And then you have Lithium Americas, which is largely permitted. I think they have still some people fighting certain things. They both confront financing risk, right? Or they're putting together their final package. LAC may get, a DOE loan. GM, likely to be there. But it's a very big project. It's an integrated project. It's not plain vanilla. That's sitting at, $1 billion market cap. Critical Elements is just like any other story that, Chris and Gina are fighting over, in Western Australia. Yeah. And then you also have something like a Frontier, which is a sizable, solid, big result, like huge dichotomy there for plain vanilla spodumene. So how do you think about that? And then also just the other thing, I'm just making this kind of comparison, LAC, Critical Elements, and then Liontown, right? So Liontown is fully permitted. It's fully funded, right? It's big, it's underground, it's maybe technically challenging. They do have long-term aspirations, so I think they go to downstream, but they're sitting at a 2.6 billion market value, fully funded. Yeah. LAC is at $1 billion, like.
Yeah, what's going on?
Or what's the upside? Like you're bullish on LAC, no one really seems to care about Critical Elements and Frontier. Like what's your view?
So let's hit those really quickly. And, I'm sure guys that work for those companies will listen to me. Really simplifying it down, just the issues. So Frontier, amazing resource. It's a big, giant blob, but it's a giant blob in the middle of nowhere, really far north. Nothing's going to get done without a road and power. And I've had meetings over the last year. I work a lot with our investment bankers, and we spend a lot of time with giant mining companies, all of whom are interested in the lithium space because they saw that spike and they're hungry and they're interested. Their view is that's the government's job. So if all the government has to do is come in and go road power, road power, road power, and that you open up all of Canada, all of these projects are caught up into that. So Frontier is great, but it's hard to understand how they're in control of their destiny because of the infrastructure issue. That's what's impeding it. They have a plan to work around that and everything else. I won't go into that, but that's the issue because people are like, I'm not sure if I believe it or not, right? If you look at Critical Elements, as you rightly said, that resource is not as good if you look at the basic elements of it because of the grade being a little bit lower, another material in there, it's a little bit more complex. But it is permitted and it is the most advanced in the area and it should be moving forward. But this goes back to something we talked about earlier. And I've had discussions in other materials where this has happened, where the government has come in and the various entities that want to put money in and said, you do realize we're not giving you money. You make a joint venture, bring in a legitimate partner. we'll give money to the joint venture, not you. Your job, little company, is to get a joint venture and to get a great partner. Then we'll come in. So there's this chicken and egg. And so part of the issue is Critical Elements is trying to make sure that they've got those partnerships. You have to do a lot of work behind the scenes that you can't talk about to get those partnerships in place, because there's a prize with the money. And the problem in Canada is there is no desire to have any connection with the Chinese government and the Chinese industry. And so you have this element of, it makes no sense to build a spodumene concentrator in Quebec if you're going to ship it to China. It makes no sense. So where's the downstream conversion capacity? And that is a question that all of the developers are struggling with. The government's doing something about it, but again, they can't say anything about it until it's done. So I think all of Quebec, and I would say the same thing for Ontario and others, will get unlocked when they solve that issue. On LAC, it's all about the DOE money, right? So they've done a fabulous job on so many elements, but the stock is now in that Lassonde curve. It's in the worst part, right? Where you got a 3-year build. You got great partners, but you're not fully financed without that DOE money. And that's a question. And we've seen this with Cyclical, for instance. The DOE money is not easy to get. There's a lot of strings attached to it, or call it legal issues you have to sort out that are not amenable to equity investors and strategics. And not that it makes the economics terrible. It's just legally what they want in place is very problematic to actually get a deal completed. That's what's holding up that. So when you have these governments, and I think, and our CEO has said this several times, he goes, I don't think the government cares at all about the equity investor. And I think he's right. And I think the equity investor knows it. And I think as a result, they're a little bit arrogant, and they're saying, well, we'll get to it when we get to it. You should be happy. We're giving you a bunch of billions of dollars. And so the issue is markets don't work that way. And from a valuation perspective, and we have a very elaborate kind of presentation for these big corporate investors to show them where the investment is lacking. So you put money in a spodumene play, there is no guarantee your product will get somewhere and be in a battery, because there's a hole in the refining part of that value chain when you talk about North America and Europe. So that's changing, but that's
still
sorted out.
North American Lithium is selling to China, so Critical Elements could sell to China for a time being.
You can do it, but you're not going to make that much money. The issue is the government is looking at it saying, we're building a supply chain. We're not building it for Chinese vehicles so we can import Chinese vehicles. There's no way. They're just not going to allow it. They'll put an export control on it if they had to. The issue is you need the material now. There is no processing outside of China. So you got the West, Europe and the US and Canada in some fantasy world where they think they can build their own supply chain, and at the same time think that China's not going to retaliate and go, wait a sec, you're trying to build your own industry around this, so we're not going to sit by idle, right? So it's a funny world we're in. It's basically seeing industrial policy being used as an economic war, in an economic war. That's what's going on. And, that can play out over years. Meanwhile, we're trying to invest for this year's return, right? It's very difficult. So there's a lot of these moving pictures. So when you go and look at LAC, I think LAC works out. I think it's going to be a good project, an expensive one from OPEX and CAPEX, but great partners in a great location feeding into their own supply chain. But it's going to be years. It's going to take years for that to play out. And that just doesn't sound great for investors, right?
But you're paying $1 billion for that now. In Critical Elements, you're paying $138 million, and no one's talking yet about their exploration upside. Everybody loves
exactly.
they have a lot of tenements over there. So what are you? Both of these companies are in the middle of that Lassonde curve.
So if you're patient, you buy that, right? Like, I actually think that the other properties at Critical are way more valuable than Rose, frankly. Maybe they need to split it up into different companies and you have a pure developer, but the other one won't get valued as much. There's things you can do in a better market. And I think they'll look at that. But their eyes are focused on Rose and the market is focused on that. And I do think if you're convinced in your analysis on these companies, you would do exactly as you say. You would look at the one that's lower valuation. Our quant technical guy would say, Mac, dead wrong. What you do is you buy strength and you keep buying strength, and you buy it until it rolls over, and then you sell and you short your weakness. It's a completely different mindset, right? So he's going to be playing momentum up. He'll miss the tops, the turns at the top and the bottom, but he'll hit the middle. But in my experience and in resource investing, you need to find, you have to go in when people are selling. And it's just, not all of them are going to be winners, but that's where you pick your winners at really low valuation.
And you also have to trade these stocks because they may be long-term, weighing versus short-term voting. But the short-term voting, if you've made 3-5 times your money, you could make 10 times, and there's bull markets that works, but take profits as well, and because we're going to have these ups and downs as you've articulated. So last thing before you go. Jumping in here from the editing room to tell you about Lithium Royalty Corp. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LIRC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com. It was just on Sigma. There was some news there that they're going to list the Sigma Brazil subsidiary, in the U.S. and Singapore. I read this as they probably have a lot of Chinese interest, and their British Columbia, domicile at parent level is problematic. Is that the reason? And what do you think is, you've been a long-term shareholder in that and you cover it?
Yeah. So a couple of things. There's the oversight issue. When you've got the governments will probably think they can weigh in on that. That's a bit of that by changing the listing, that might get around that. I'm not totally convinced you can. The second thing,
I don't know. Are they going to be okay on NASDAQ if the Chinese want to buy it?
Exactly. There's a tax issue too, right? Like certainly the way there's, the original shareholders have made a lot of money, and depending on where you're listed and your tax issues there associated with any bids, I'm not quite sure how that plays out, but there's, whether you're getting, whether it's the way in which it's taxed and how it's withheld is a consideration if you own billions of dollars of stock, right? So that's an issue. And then you simply have the valuation disconnect. We do see some mining companies that have Singapore listings that have better valuations, but it's not always perfectly that way. So you do have a number of factors that make sense that all of them are aligned. I think that's what's happening with that idea, and that might be able to get those things sorted out even without an actual listing. Like you could perhaps just start it even in the midst. Like I think people are trying to read, does this mean the takeover is not happening? I don't think it means that. I think it's more about positioning it for legal and tax issues.
And you think it's a takeover as opposed to some joint venture partnership?
I think so.
Yeah,
that's my feeling. Like I don't, but I might be wrong, right? I don't have, the company's not been adamant one way or the other.
Yeah, I think management is committed to sell. If they see a liquidity event, they're incentivized to do it. They're major shareholders. I think the question is just the mechanics of how you do it.
And who do you think buys it? Like you got to go, Mac?
Yeah, I got to run. I just realized I'm running late now, so I got to get changed for work.
Thank you very much, Mac.
Thanks,
and like
guys.
I said, I think we just barely scratched the surface here. We could have you on again early next year.
Sounds good.
All right.
Take it easy, guys.
Thanks, Darko. We have some more time. We could just carry on. I have a few. Want to talk about some of the stocks you're invested in, or considering. But any further comments on Sigma?
Yeah, look, we followed the name for a while. We actually bought back in very recently after the pullback, pretty much thinking that this is going to be a corporate-driven thing. Obviously, operationally, it's ramping up. It's going to be generating cash, all those kind of things, good things, which will help support the valuation. But probably just talking to Anna and her strategy over the years is, they are incentivized to sell. So I kind of think, the upside, what's the upside? What's the downside? I think at these levels, probably downside is limited, but upside could be material, assuming, they're successful in selling. And as we've just mentioned, I think they are incentivized to sell. It's a very good asset, great location. Brazil offers significant advantages in mining relative to other jurisdictions. So it'll be interesting. As to who buys it, look, the obvious, clearly one thing that, we keep on hearing, and even in this pullback, is Chinese customers are still buying material and honouring their offtake agreements, unlike in the previous downturn where they quickly cut purchasing because they were looking to destock. And from what I understand, talking to companies, that has not happened yet. So, and they're constantly being asked to open their doors to look for new contracts, look for new offtake, all that sort of thing. Pilbara, for example, is looking to partner for about 300,000 tonnes of concentrate for their P1000 expansion, and they're looking for partners, and they're very confident in saying that sometime early next year they're about to make some sort of announcement. What that means is they're willing to trade offtake for equity stake in some downstream opportunity, whether that's an intermediate product or something like an equity stake in a refinery converter facility, like they do have with POSCO. So, it could be the Chinese. I think that's a high probability. But I have also heard, which I think is a bit different, is that they are looking for still being opened up, is where do the Koreans secure their supply? And, the Chinese have managed to, not only build their own assets, but also buy significant offtake from various parties. The Koreans and the Japanese less so. And I think if their growth is what they say it will be, then I think they also need to lock in long-term supply sources. And what I have heard, it could be some consortia like that. It could be another alternative to the Chinese.
I think that would be interesting. The Koreans just announced $29 billion is going to be made available by the government in loans and equity to their companies. So maybe what you just said has merit. I had heard a few weeks ago, just rumors of, Rio Tinto and Volkswagen, which is very possible, but Rio typically wants much bigger assets. So this is not that big. And they've also talked about not paying up for things. So we shall see. I always wondered why Vale wouldn't, it's right in their backyard. This would be the perfect entry for them, but that's all just, idle speculation. Before we go and talk about, some more of the companies, could you talk to this chart that's in this letter that you put out in December about, global investors, underweight metals and mining, and this could explain the valuation discrepancy that you're talking about. Almol used to trade at much higher multiples.
Bank of America does a monthly survey called the Fund Manager Survey, which they publish obviously to all their clients. And they pretty much monitor, cash levels, level of bullishness, bearishness. Just a recent survey has come out basically that the cash levels have fallen as people are committing more capital back into equities. And you can see, with the Nasdaq up 40% or thereabouts year to date, or the S&P up 20%, clearly that's encouraging investors to take cash off their portfolio and back into the market. But what they haven't done is reweighted significantly to resources. In fact, the most latest survey indicates that the level of underweight is similar to what it was in the GFC, the global financial crisis of 2008, which I find fascinating, but not unexpected, because I guess what's been challenging this resource space this year has really been growth concerns. You often pick up a lot of information that the US is kind of economic, I would say slowing down materially, but certainly not growing materially. Europe has got growth problems, and in fact, Germany is struggling, probably in a recession as we speak. And China has been a disappointment, really, post-COVID, because people have been anticipating a much faster turnaround, and that's been a lot more muted. So all of those factors, have been weighing on sentiment for the resource space, and I think that's part of the reason why the space is reasonably underweight, given that you've got alternatives that are performing materially better than resource outlook.
When I'm looking at this chart, I see, if I go back into the super cycle in the 2005 to 7 period, you had funds went overweight, and then the commodity sector outperformed. But since 2013, you've had periods of time when they've gone overweight, but they've still underperformed. Right now, we're in a period where they're underweight, but they were most recently, or the funds flow. Actually, the fund managers net percent that say they're overweight materials. In 2021, 2022, it showed that they were overweight. And you could see this very sharp rally, from 2020, but still it underperformed. It's still below this zero line. But right now, you're showing that they're net underweight. There's an opportunity, obviously, in commodities broadly. If they start to go overweight again, we'll have a rally. But I guess it's this whole Magnificent Seven dynamic and the tech and et cetera that must explain so much. And in the S&P 500, 493 stocks generally are underperforming relative to those other ones. But anyway, it's an interesting chart.
So, Darko, you mentioned sort of where the focus was and development versus earning companies. We've seen some recent resource updates and announcements. One in particular was Winsome, just under 60 million tons for its initial mineral resource. If you look at its market cap less the cash on hand, we've seen what brokers were suggesting was a value of a ton of resource come off substantially in that instance. Your thoughts on that company, and in general, what do you think? It does depend on how the resource sits and how economic it is. Your thoughts on Winsome and that concept in general?
Yeah, look, as a general comment, it's fair to say that maybe 5 months ago, 6 months ago, the announcement of their maiden resource, it would have been, the stock would have been up 10%, not down 10 or more. So I think partly the performance post the result speaks to the fact that we're in this bearish market right here, right now. And the question is what will change that? But that's another question, and we can talk about it later. But so look, I thought it was a good resource, certainly a good initial position. I think the ore body is shaping up quite well. I think it'll get bigger, of course. I do think there will be a tiering now going forward, and that is if you've got a modest resource, 20, 30 million tons, and that's all you have, I think the market may or may not give you much value for it. But I think what we're seeing is those tier one type assets, the 100 million ton plus discoveries are where the kind of action has been. And that's obviously been Liontown, which has got about 150, 160 million ton, 1.4%. That is a tier one deposit. Pilbara obviously has got a tier one deposit. Azure doesn't have a resource yet, but given the drill results that it has, it's imputing that this will be certainly over 100 million tons when that MRE comes out, or at least a sight to 100 million tons. But if we go back to Winsome, I think, look, again, I think the first resource is good. I think it'll get bigger. I'm not going to say there's no doubt, but you can certainly see, plus 100 million tons. And that by itself at that grade should be economic in any criteria. I think given that it's listed on the ASX, I think probably part of the headwind now is this perception of permitting risk and time in Quebec, and also its location. This perception that it's isolated and that it'll be challenging to develop. I don't agree with that. Whilst obviously it's not situated next to a road 200 kilometres from the port, like some of the West Australian assets are, it's got significant offsets, and those offsets are it's operating in a good jurisdiction, a mining province, exceedingly low power costs to do whatever it wants, and access eventually to the property through roads, etc. It's already got access, although it's a circuitous pathway. That'll change over time. And probably also a competitive labour force relative to, say, labour costs in WA are much different to labour costs in Quebec. So when I look at it, I think the project itself will be a project, will be a mine at some point. Obviously, there'll be the studies have to take place, but I think it's a good one. And I think, so's Patriot. Obviously, that one's not, would say more challenging, but people were starting to get concerned about the lake and water permitting, etc. But again, most of the additional tonnes that are being discovered to the west, away from the water, and that'll be the startup of the operation, and eventually the water permits will be received, and you can then build the coffer dams and all the rest of it to build the mine. And eventually the road network will be built, etc., etc. And McMurray was saying, actually, these assets won't need subsidies. They won't need any encouragement if allowed to be built. And I thought that was an interesting point, because none of these will be built if you expect them to have a downstream solution, because it's too early for them to even contemplate building a refinery. I think someone else has to do that. Whether that's a merchant player, and I know there are probably half a dozen companies going around that are planning to build merchant refining capacity, mainly in Europe, possibly in the US, and maybe even in Canada. I know RockTech is one, which is a Canadian company building one in Germany, but has considered building one in Canada. Because I think that's a different ball game. It's a different skill set. You need a lot of capital. And to try to do that as an integrated player from day one, it's not going to work. So for these projects to be built, there needs to be a concentrate solution for a period of time until they can get enough cash flow, improve their balance sheet, and then you're ready to go into a downstream opportunity. In fact, there's an Australian company called Green Tech Metals, GT1. They've got a project in Ontario, and they're considering a refining project in Ontario from day one. But their business model is to actually be use some of their own material, but actually be open to third-party sourcing to produce lithium hydroxide. So that's kind of their business model, and that could be a solution for a Patriot or a Winsome at some point in time. I think the refinery is being considered at Thunder Bay, and the project is up a couple of hundred kilometres north of Thunder. And in terms of Winsome, in terms of valuations, I use a little metric for these resource names as EV to dollars EV to contained LCE, and Winsome is about $75 tonne per LCE, total resources, and the sector average is about 180. So you can see it's materially discounted. So the question then is, what will be the catalyst? And I suspect the catalyst will be just the general improvement in sentiment for the space. And then the market will see how cheap it is.
Yeah, that one, that's an RK Equity client and investment, and it's just been, they over-delivered on an under-promise in terms of time and size. And, again, markets are inefficient. There doesn't seem to be, there's no lake issue. There's no obvious, no one I'm speaking to is coming up with a good explainable reason why it would go down. But just more sellers than buyers, and you've seen the end of the year. It's a funky kind of time of stock price performance, and oftentimes you'll see good news. There'll be some liquidity, and then just some investors for whatever reason need to sell whatever they can to have liquidity. I think that's the dynamic there, but luckily cash is king, very important. There's going to be a lot of company running out of money. There's going to be a lot of equity raises next year. And I think Winsome did a really good job to get 70 million, or they have, I think, 65 million in the bank. Yeah. And someone had a chart. I was just looking on Twitter, just comparing Patriot to Winsome in terms of how many meters drilled and how much resource they have. And they've only released 25,000 meters, Rodney, and they have many more holes to come. So resource upgrade is likely. Fingers crossed they can get to that 100 million ton bit. In the last just 5 minutes here, we're ending the year. Livent, Allkem merger has been approved from the Allkem side. I think today the Livent side, but I don't think there's any real question on the Livent side. If there was any question, it was on Allkem. So that deal's going through. And you've also had Azure, partnering with Hancock. We had a bit of Rodney asked Ken Brinsden a question, is Chris and Gina going to partner, or are they going to battle it out? It looks like Gina won here. Minres, has bought stock at higher prices than the current price. They're sitting there with 10%. Do you think he sells into this deal, or? And Mark Creasy is another billionaire who's entering the fray. Like we're mostly talking about Hancock and Gina. So, what do you make about it as an Australian sitting in Australia? Thank God we're concluding with deals consummating and not like a busted Albemarle. And Liontown stock is up. People are speculating that Albemarle now will cut a deal with Hancock. So let's end on WA M&A.
I guess in terms of, say, Azure, look, it's an interesting deal because I guess the big surprise this year has been the Hancock Group. They're obviously an iron ore company that's done really, really well. They're private, so they've never actually articulated what their strategy is in this whole thing. But maybe today's announcement probably will start to give you a bit of a see-through of what they're planning. And because they're an iron ore mining company, they have no interests yet in lithium other than what they've bought on market, and they don't have any processing technology or anything like that. I think this could be a similar kind of approach to what SQM and Wesfarmers did with Mount Holland. And that is, it was one way for Wesfarmers to enter the space with an acknowledged operator that can build and operate the asset, and they'll have a see-through to a full integrated model down the track. So they'll be producing chemical rather than necessarily concentrate, and you de-risk that process from that perspective. Gina and her group have got phenomenal cash flow and cash, but what they haven't got is the technical experience, and that's what SQM brings. The question will be, and I guess Mark Creasy sees that, whilst the deal has only really been for Azure, which owns 60% of the project, there is speculation that Mark Creasy will eventually sell his stake as well into the pot. As far as Minres is concerned, Minres is a different story because it's obviously already a lithium player, but it's also a hybrid company that's a mining services company and also a mining company, both in lithium and iron ore. But when you look at its hybrid model, it does something different, and that is it extracts value by leveraging its equity position or joint venture position to secure the servicing aspects of the mining activity at the site. So, for example, at Wodgina, they have a life of mine mining and mining service contract. They've got the life of mine trucking contract for the product. That's how they add value to their mining services business, which is growing fast. And that was the backbone of the company. So if you look at their M&A transactions in Western Australia, they're now taking it to a next level. And in Mount Marion, they bought Bald Hill, and they've just developed an underground mining contract to to work at Mount Marion, build Beaumont asset. They've got a little lithium story themselves in the broader district in southern Western Australia, and you can see the makings of a hub and spoke strategy where MinRes will build on its Mount Marion by using a hub and spoke and taking these smaller satellite deposits, which may be uneconomic independently, but could be economic as a satellite mine truck the ore to a central processing mill, and that's how they extract the value. And if you look at their position in Wildcat, which is Wildcat is the follow-up to Azure. It's made what looks like a significant discovery in the Pilbara district of WA. I wouldn't say not far, but let's say 50 kilometres from the Pilbara operations, and I think about 80 kilometres from the Wodgina operations. MinRes has got, I think, a 13-14% position. So what you can see from them is that for that project to proceed, they might say, look, let's proceed, but what we like is the contract to mine, contract to truck, all those kind of things on top of the equity stake in the project. Whereas with Gina, she's obviously playing that new entrant, but with an experienced player. So I think that could be a very good outcome, and I think it would be a good outcome for WA, lithium hard rock mining. And as far as Allkem and Livent, I think actually that's a great company, emerging great company, because I think Allkem, I think, had a fantastic portfolio of growth in Argentina, and obviously an opportunity to expand in hard rock with James Bay. Whereas obviously Livent wasn't more of an asset-rich story; it was more of a integrated player that's got access to different markets and different processing technologies to access those markets. So I think combining those two, I think it's a good situation for the company going forward. Now, I see that company being re-rated materially over the next few years.
I agree with you on that. We've been big fans of, call it Rocky 3 or Rocky 4, Philadelphia Freedom in Livent. This is Paul Graves' saving grace after 5 years of not doing any deals. He did one big deal, and I think Arcadium, Argentina, Canada, from with Nemaska and James Bay. James Bay got they're not yet permitted, but I think in terms of building downstream conversion capacity, which is what you and Mac were kind of like lamenting as a problem, in Canada, that they certainly have the means to do it. Watch this space. Darko.
And I think structurally Argentina's got phenomenal growth, and now that they're working on a trading agreement with the US, and Arcadium being effectively a US company, I think that opportunity to sell more product into North America, closer relationships, all that kind of stuff, it bodes well.
We could spend a lot of time talking about Argentina. They just had an election. I'm optimistic that maybe there'll be a Macri-like moment for Argentina, like several years ago, but we're out of time. So maybe next time we can talk about Argentina. I wish you Merry Christmas and a Happy New Year. All the best in this festive season, Darko and Rodney. Thanks to all, Rockstock channel, all of our viewers, our Patreons. It's been a volatile year. It's been, it was pretty optimistic for the first, few months. And then, the last few have been a challenge. But Darko, what would just be what's your gut feel on, recovery? Is it 3 months? Is it 12 months? Is it 18 months? Like, when do you think, we'll be talking more optimistically from a market price perspective?
Yeah, look, I was just talking to a couple of people about it today. I think even with prices falling, they continue to fall. But I think what we've noticed is the stocks themselves are not falling at the same rate. I think so. Maybe there's a sign that stocks could be bottoming. The question is, what's the catalyst to return? Look, I suspect what I want to hear is the reversal of the things that went negative. I think that's basically a sense that EV demand is stabilised and possibly growing. A sign that destocking along the supply chain has kind of come to an end. A sense that customers continue to purchase their allocations, and we still that's positive. The last IGO quarterly indicated that Changshu will not be taking material for their converter in WA from Greenbushes, so that could back up a bit more inventory or whatever it may be. So I think I want to see that systematically cleared up, and that's yet to happen. And I think the other one, depending on time to the turnaround, is whether we do see some production cuts from existing producers. And so far, there's no sign of any of them cutting production. In fact, most of not all of them, but some of them are certainly expanding capacity, and they continue to expand. So I guess all that signals is that maybe the fundamentals of the market are not that bad. But if I was to see them cutting production, that could be a positive catalyst, because that would hopefully tighten the market in the short to medium term. So that's what I'm looking for.
I think we might get that from Albemarle. I have said many times that I still think we have a lithium spodumene duopoly with Albemarle and Pilbara controlling Greenbushes, Wodgina, and Pilgangoora. You've talked earlier about it's not iron ore, in that iron ore is slowly growing, and it's a concentrated oligopoly. Lithium is fast growing. But do you agree that it's a duopoly, at least in the short term, before all these other, mines that are being developed get into production?
Yeah, look, there's still top 5 players, and they dominate the market. Obviously, they're growing at the same time. But I guess it's not so much, maybe Mac sort of related to it. It's not, the other feature of the downswing is that you do have this wedge of supply that's come on over the last 12 months, and that has to be eaten up by the market. So it has to find an equilibrium of some sort. And maybe that's what's happening. Maybe the first sign that I'm seeing is that potential DSO components of a project have been cancelled. So, for example, Liontown had a DSO idea, and that's not happening anymore, which kind of is telling you that that element of the market's cooled off. I know that Sigma possibly may be selling their low, but maybe it's not. So I think that's another sign that the demand heat is come off, and that sort of stuff's not needed, which is, to me, generally a good sign. And now we just need to see that sign of supply-demand equilibrium in the short term, and then I think the underlying demand of whatever 20% plus or minus CAGR, I think that'll clear the decks pretty quickly. And assuming there's no global recession, for example, next year, I think sometime probably in the first half, we probably might reach the bottom.
Great. Thank you, Darko, and thanks again to all the Rockstock Channel viewers and Patreons, and wish everybody a happy festive season, and for all better things in lithium, happy, healthy, and prosperous, 2024. Take care.
Thank you. Likewise, guys. All the best.